Kalimera Antrovos, good morning everybody. Special edition this morning. There's been a bit of moving around with regional bank stocks. So what actually is going on? So I don't know everything, and I'm still grappling with the balance sheets and thank yous and stuff like that. Okay, so it's good that nobody is watching, but if somebody tunes in, that will be amazing. Not for the viewers, but we can understand basically what's going on. So let's start from this. Right. Okay, stock indexes fall as regional bank stocks plunge. Okay, and we have a sequence of Zion, Western Alliance, Zion, Bancorp, Western Alliance, Bancorp, Citizens Financial Group, Keycorp, Truist Financial, Untitled Bank Shares, Regions Financial, Canview, Euro Parket. Okay, no, I have a Parket. It's not a thing. So this bunch of banks have been dumped in the market, and with some reason. I will try to not to explain anything, just to clear up. We will see together what are actually the real numbers, because there is not much to explain. It's basically just go and check for the thank you, and you will find a lot of interesting things. So that's March, December. Okay, so what is the problem? Recently, the repo rate has been increasing, and we are at this situation. Okay, so the repo rate, it's something around 4 to 5%, 4.3%, something like that. It can also spike to just become more volatile and be something like 4.4%. The Fed, it's 4.1. Right, so the repo already has a bit of a markup, a spread on the Fed fund rate, and the 10-year treasury, it was around 3.9 and change handle. So the 10-year, it's basically on a downward slope below the Fed fund rate, something that has been noticed by anybody in the market, and I had to catch up with this thing just to understand what was going on. And so that basically we have a situation like the Fed fund is here, we have a downward slope convex curve, then it goes up, and then the long-term duration, it starts to go below the Fed fund rate. So we have the first and second derivative effect here. So that means we are having, even in the long duration, a sort of recessionary market signal. The long-term growth is not 4%, it's not 3.9%, it's somewhere around 3.8%. Long-term growth plus inflation and I don't know, the base rate. So that anticipates a federal funds rate, which will decrease in the coming quarters. It depends on inflation and on other things. But basically, when you have an inverted yield curve like that, okay, then we are talking about some slowdown, some short-term distress in liquidity, and basically slower economic growth. So in financial market, in money markets, there are a lot of things, a lot of dynamics. How can I say? There are a lot of dynamics that basically change the shape of the yield curve, the convexity or the concavity of the yield curve, and the steepening and the slope. So that depends, okay, supply and demand of treasuries, okay, but it depends mostly on the liquidity, and of course it depends on the interbank liquidity, so the liquidity distress that can come up between banks. So you see that the repo rate goes up because the Fed asks for a higher premium for banks to have overnight liquidity, or 5 days, 7 days liquidity. And on the other end, what happens that in the open market, investors, they start to buy longer duration. For what reason? I don't know exactly. I'm not in the mind of these people. I'm trying to find a... Okay, I cannot cancel this thing. It doesn't matter. Okay, I found the method. Okay, so we have a situation where the repo market, it's at 4.25, 4.3%. The Fed is slightly lower at 4.1%. And the 10-year treasury, it's receiving a bid. So there are funds or banks that are buying into longer duration debt. And that depends not only for the economic growth scares, we are going into recession, but buying 10-year treasury, it can be also a sort of investment strategy for the repo market or the reverse repo market. Okay, so it can be also that banks, they buy treasuries because they want to provide liquidity within the repo market, and they can basically, this tri-party repo market, or if there is a smaller investment fund or an hedge fund that needs liquidity, it basically it goes into the market, buys 10-year treasury, and can utilize the collateral to the large bank, post the collateral, gather liquidity, and then continue to function. I don't know, it's a bit of a convoluted turn of things. So we can eventually, let's see if I found a bit of space. We have the hedge fund as some treasuries, and you can post the treasury to a bank, or the bank is the intermediary that goes to the Fed for the repo, right? For the repo market. The repo rate is 4.25. Let me double check. I believe last night was 4.36%. Oh dear. Bear with me. Nobody's listening, so I can do whatever I want. I don't mind. So what was the repo rate? repo rate. Yeah, was normally the repo rate has been in the past weeks something like 4.25. It has gone up to 4.36%. So already we have a volatility in the repo rate. So the hedge fund can use the intermediary bank for the Fed repo rate. Okay, so the repo rate tends to go up whenever there is some sort of short-term liquidity. Also, the bank can go to the Fed for the repo rate. So what happens into the market? There is demand for collateral, right? And so that means that there are, to my interpretation of the dynamics, is that there are two reasons. One can be the growth scale, okay? The rate of economic growth is not as high, or the long-term inflation expectations, they are lower than what were discounted 3 months ago or something like that. I'm just trying. And so I can take interest rate exposure, volatility exposure towards longer duration. But otherwise, there is also a liquidity component that characterizes the dynamic of interest rates, of the demand in the market of for collateral. Okay, so we can see here that the 10-year treasury has peaked here, this area, and it's bumping around, and in this month it has gone from 4.16 more or less. We are at 395, 396. Okay, and that's not in real time, because it's not in real time, I don't mind. But anyway, it's the yield, it's on a downward trajectory. That means that there is demand for collateral, because at the same time the yield on the treasury is 3.95, but the repo rate is 4.36. Okay, so the repo rate, of course, naturally it's higher because it's short-term liquidity. So, but that means that, not naturally, but that means that short-term liquidity is perceived or is priced in as is riskier than, gonna risk it for a biscuit. It's riskier than long-term 10-year treasury, and that's a sign of market distress, liquidity distress in market. But because we have distress, short-term distress in market, I would not take for granted that the 10-year treasury, it goes down to 2%. I think it's very much possible, and it's a fact of when there is market distress. So now we see that the yield is here, and we say, okay, it's going all the way down that way. Okay, it's going down, I don't know where. It's going down to 2.5%, or it's going down to 3%. I will not take it for granted, because if there is distress in market, the collateral, the yield can spike higher, because basically there is a urgent need for liquidity, and so what happens, it happens the reverse dynamic. So then in an active market, funds, investment funds or small regional banks which need liquidity because they have a mismatch in their books, what they can do, they have to actively sell into the market the most liquid asset that they have, which are treasuries, so the yield goes higher. Okay, so there are these two scenarios. Okay, now the 10-year treasury is 395 because there is demand for collateral, and the demand for collateral is matched in the repo market, and the repo market overnight rate is 4.36%, and it's higher than the Fed funds rate. But if we have a situation where hedge funds, investment funds, or the hedge fund which is client of, I don't know, Jefferies Bank, or is client of Wells Fargo, is client of JP Morgan, because there are all these large banks which give money, they don't give it for free. They seed with tens or hundreds of millions of dollars small hedge funds. If these hedge funds they have the wrong bet, then what they can do, they have to sell treasuries. If they have treasuries, unless they otherwise they go bust, because if they have pledged treasuries to their liquidity provider, which can be, I don't know, JP Morgan or Morgan Stanley, and then what they can do, they have to liquidate the fund. So there are a lot of dynamics, but this is all based on speculation. When there is basically when it's investment funds or it's credit exposure, which in this case basically is most concerning for the small or the regional banks. But we have to bear in mind, we have to consider that the 10-year trade, there is demand for collateral, but if there is in an active market, if there is a need for liquidity, then the first thing that you sell is treasuries. Okay, is sovereign debt. It can be German bonds, it can be treasuries, it can be gilts, it can be I don't know, Swedish bonds, Italian bonds, whatever. The most liquid form of debt security, which is sovereign debt, you just dump the sovereign debt and take the market liquidity. But then there is the spread, the bid-ask spread widens. So there are all sorts of things which are very funny indeed. So, and that's so. The 10-year treasury, the yield can go down, but it can suddenly just go up, have a lot of volatility, because if there is distress in market, then let's say funds, they go into the repo. So repo, it's overnight liquidity. But if during the active market there is liquidity distress, the yield goes up because they have to sell treasuries to gather liquidity, or they have to sell gold. So there are two things to watch. If gold starts to be liquidated, that means that there is liquidity distress in the market while the market is open. Okay, then for the overnight market there is the repo market. Okay, when I take the treasuries and I pledge it as collateral for a repurchase agreement, and basically I have to pay, the investment bank has to pay 4.36% of repo rate, and the spread, we have 3.95, there is a spread of 40 basis points. Okay, and also large banks can buy treasuries to basically to earn this 40 basis points spread in the repo market. some sort of thing that can be done. So these are the dynamics. Now, when it comes, for example, to why Zion Bank stock is gone down minus 10%. Let's see if because here, first of all, here we have this the ratios like the Tier 1 ratio. So those are the stress test ratios that banks have to fulfill, and we see that current capital ratio 10%, it's acceptable, but it's not that high. It should be more than 11 or 12%. So the minimum required for well capitalized is 6.5%, because these are regional banks, but I don't think that's the appropriate that's the appropriate risk measure, because basically Zion Bank, like Western Alliance, as well as Western Alliance, they have some horrible books, some horrible balance sheet. So Zion Bank is here. Yes, no, this month, this is not only of yesterday. The whole month is gone from 59 to 46. That's the share price in the market, and eventually it's going to go lower. We were already at 12. This is the share price basically already explains that it's not there is something fishy in this thing. What is fishy? Fishy is here. Okay, it's very easy to see. Total credit risk exposure, it's 110 billion and 861 million. Okay, so basically we have $110 billion of credit exposure. To what? To investment securities, the government agency guarantees. Okay, 18 billions. So other without government investment securities without government agency, okay, 1.4 billion. But here we have the big thing, the big item, loans and leases, 60 billion, and then we have unfunded lending commitments, 29.5 billion. So basically it's this bank burns cash. Yeah, they have some unfunded credit commitments for 29.5 billion. No, they just give money away like fresh water. I don't know what they do with these things. And they are in the business of commercial real estate and stuff like that. Credit exposure, we see here commercial real estate, finance, insurance, manufacturing, and then total of commercial real estate at 31 billion. Total commercial lending, commercial credit or loans is 31 billion. Commercial real estate, 13.5 billion. And then they have consumer credit, which is 15.3 billion. And we have home equity credit line, which is 3.6 billion. So these are people who have used their houses to the equity in their houses to gather liquidity. And we have another problem in the United States of people, multimillionaires, who basically take equity. There is this funny stuff. There is this top 1%. What do? They have a house. There is a house in New Orleans. It's called the Rising Sun. It's worth on paper, because we have an asset bubble in the real estate, $10 million. And then what they do? They go to the investment bank. and they say, okay, I have a house, it's worth $10 million, can you give me equity credit line? They go to the wealth management, investment bank, wealth management. The wealth management, I don't know exactly how it works, but perhaps they say, okay, I want to give you 70%, so I give you $7 million on the house, right? Then the top, they take this $7 million and they ask the wealth management to put it in the stock market. Okay, in stocks. It goes into the stocks. The stocks goes up, and then they seem to be very rich on paper, but probably they have extracted equity from their houses, the multi-million mansions in California, and they invested. They use wealth management services for the stock market. So that's another very funny stuff, because when stocks go down, as it's been happening today, yesterday, and probably next week, and these people, they are worth much way less, but still they have to pay the wealth management for their home equity credit line, and so that's where all this mambo jumbo here of 3.6 billion, for example, which is only Zion Bancorp, goes haywire. And there are also 10.3 billion in mortgages, 472 million in credit cards, 762 million consumer real estate, but basically we have here the total credit exposure of 60 billion. Now, as it happens, all this credit exposure, basically some people, they start to go into this. And here we have the geographic distribution, which are Arizona, California, Colorado, Nevada, Texas, Utah, Washington, Oregon, and others. So it's across places in the United States, which I've never been to. So for me, these to me are just only states or regions of the United States, and what can I do? So that's the bulk of the situation here. That's basically this Zion Bank. It has 110 billion in total credit exposure. The capital ratio requirements, they are not really 10%. These numbers here, they are not accurate. The stress test is nowhere near the scale of the loss the loss on the credit exposure that the bank is gonna take. And so that's why the repo rate is going up, because there is liquidity distress in banks. Okay, when clients, they start not to pay back their commercial real estate loan or their credit cards or their home equity line and stuff like that, when credit starts to be a problem, then the bank has a bit of a problem in balancing the book at the end of the business day. So they have to use the repo to gather the liquidity to match what are their the equity or the asset and the liabilities, let's say, of the balance sheet. Okay, so the balance sheet has to be matched like a zero sum at every business day, and so if they are short of liquidity for any sort of reason, it can be They placed the wrong bet in the derivatives market. Some credit derivatives securitization that they have issued, it has lost value, so they have a margin requirements, or their clients they start not to pay. You have a deterioration in the credit exposure. So there are so many reasons. That's why the banks, they have the value at risk portfolios, the value at risk numbers. So they have to know exactly their portfolio, how much is exposed every day. So it's pretty much it's not so complicated. But because I'm not an employee of Zion Bancorp, and I'm just having a butcher now at the thing, so I'm understanding a little bit what are the dynamics of Zion Bancorp. We have the thank you. So why Zion Bancorp? It's a bit of a problem because there are 110 billion in credit exposure, and they may have some items which are off balance sheet. Other off-balance sheet liabilities here, 473 million off-balance sheet exposure, which are not disclosed. And total risk-weighted asset before excess allowance, okay, risk-weighted assets, 68 billion now, okay. So there are off-balance sheet exposures, they are unusual. Commitments, okay, 7.9 billion. There are off-balance sheet exposure here. We are almost 8 billion, which are not consolidated in the total credit exposure. These are basically, that's probably the most risky part of the whole thank you filing, and so it's the risk-weighted assets, okay. I'm not an expert in these things, but basically there are off-balance sheet items which probably also are the source of the bank distress, the balance sheet distress. Commission letters of credit, okay. Okay, so exceeding 1 year, so these are more than 1 year, but we don't know when they come to maturity. These commitments, it can be 24 months, 36 months, so still it's near-term liquidity, which is some off-balance sheet commitments, which are heavy, 8 billion, okay, that's interesting. We can try to figure out also with AI what that means. That's for another day. Okay. So that's that's Zion Bancorp. Okay, now we have another one, which is, for example, is Jefferies Bank. Also, the stock went down 10%. Jefferies is another kettle of fish because it's an investment bank. What they do, they use a lot the repo market. So we have an intensive use of the repo market. Securities borrowed, securities sold under agreement to repurchase. So basically, Jefferies is exposed to the repo market for 12 billion or more, and that's basically, or 8 billion or more, and it's a source of, it's a sign of liquidity distress. I'm distressing myself right now because I'm not an expert in these things, but for what I can understand is basically they need to access the repo market for such liquidity, like 8 billion, or they, on the liability side, they have 12 billion of liquidity needs securities sold under agreements of repurchase. So basically they pledged 12 billion of treasuries for repo market, and so it may be that yeah. So as investment bank, which does a lot of things, as Jefferies is also, I believe it's some sort of broker or provides liquidity to other hedge funds. It relies, it needs the repo market for some consistent liquidity, which is 12 billion at the minute. In fact, here we have payables, broker dealers, and also receivables from broker activity. Here we have receivables 2.8 billion, payables 3.6 billion. Okay, so these are broker or investment firms or brokerage activities between payables and receivables, which basically are utilized to settle or to clear what are client transactions. If Jefferies provides brokerage services for other clients, then of course they have these cash flows between payables and receivables, which basically pulls together the transactions of the clients in financial markets. So these are heavily linked to financial assets speculation, which can be shorting stocks or buying stocks. And then there is all sorts of things. Then basically if I have an hedge fund that goes short a stock, then Jefferies has to lend the securities, or it has to borrow the securities from the stock exchange. There are all sorts of dynamics which are very complicated. I'm not a market maker or a broker, so I'm an humble person which tries to understand things. But the most significant data, the biggest data, is this one, and they need the repo market for their operation. They may need the repo market, they may do the reverse repo agreements, but they need some liquidity of the tune of $12 billion to keep enough liquidity for their operations, which can be broker operations. They provide liquidity to other hedge funds. I think there is they have clients which do that stuff. We see here that they have activity in the derivatives market, the over-the-counter derivatives market. So they have exposure here to commodities, swap, forwards, CDF, credit default swaps, total return swaps. So considering that Jefferies is an investment bank, they do speculative market activity and they provide liquidity for hedge funds, and then they trade in derivatives. So that's why they utilize the repo market to fund their balance sheet for the daily liquidity or the month-on-month liquidity for their business too. And then they try to earn spread by doing the reverse repo, or they trying to earn money by providing credit or with investing in the stock market. But still is a very risky activity. So if the stock price went down 10%, the reason is that probably the need of liquidity that Jefferies has for the repo market is perceived as a quite risky. It's a risk, basically. Okay, so let's see. Okay. Okay, corporate actions. Oh, okay, so that's the previous period. Yeah, okay, yeah, so they have, here we see, this was August, overnight activity, and we have here the maturity, 30 days, 90 days. So they have arrangements for which they lend money for collateral pledging. So they either act as an intermediary between hedge funds and the Federal Reserve, or they could be the actual provider, and then that means that if the repo rate is 436, then Jefferies will have to earn a spread on that, so the rate on this should be higher. Okay. Okay, derivatives, so they have in August they have so 848 million derivatives activity. But I want to find the okay. Yeah, okay. So here are the notes consolidated financial statement where they explain, okay, to manage our exposure to credit risk associated with securities financing transaction, we may enter into master net agreements and collateral arrangement with counterparties. So that's the basically here they show what they do in the repo market. So repo and reverse repo. Okay. And then here securities received as collateral 54 million. That's from the asset side, and the liabilities. Okay. So they have quite a lot of business going on in gathering liquidity in the repo market, and also providing liquidity with the repo and reverse repo transactions. So that's why, that's one of the reasons that can explain why the stock, Jefferies stocks, went down 10%. Let's see if we can have the chart. I'll try to find an answer which is compelling. Okay, now meanwhile we'll try to see Jefferies Bank. I'm a bit Jeff. I don't know how they incognito, how they say. Okay, Jefferies Financial Group. So is a financial services fell, and yeah, we see here stock price. Jefferies is cratering, is totally cratering down, and it's basically already in September. So I believe we have a bit of a problem in the financial services industry. That's interesting. Okay. Yeah, so that's very, very interesting. See, Jefferies stock, it's cratering down. It's really going down very fast. This is a bit like the Big Short. So now, what is why Jefferies Financial? It's so risky, and they are selling the stock because we have here a lot of activity in the repo market, as I was saying before, and that explains why Jefferies Financial, the stock of the company, is very, very risky, because they have short-term liquidity needs for their operations, which are not negligible. It's $18 billion. So they sold 18 billions of treasuries in the repo market to gather liquidity. So there are two things. First of all, that the repo rate, it's 4.36%. So the cost of refinancing the repo rate basically is a constraint on their day-to-day operational margin space that they have. And also, whenever the counterparty, as explained here, to do the securities must agree collateral arranged with counterparties. Okay, whenever the counterparties they are not willing to roll over this 18 billion repo, then basically the whole Jefferies financial financial group goes is short of liquidity. If the counterparty doesn't feel right that they can roll over the repo liquidity, then Jefferies goes bust, goes belly up, because they need to find other liquidity to continue to function. So here we have a funding problem. so which is in the model of running the financial firm operations, which is betting in the stock market or betting on derivatives or providing liquidity to other hedge funds and stuff like that. So that's is very, very reasonable that the stock price does that again, goes down again, and it can go. I don't know. I cannot price the stock like that on the hoof, because I may say anything which is wrong. But people who are investors in the United States, which know way more than me, and they are into this stuff, they are into the market, they know that probably the Jeff Financial Group is not really, their balance sheet is not really safe and sound, and in fact they have this large repo liquidity requirements for their operations. And because it's a financial firm which basically gambles in the stock market, whenever anything goes bad, or probably they already have some exposure to derivatives, they have some other parts off balance sheet which basically they are I don't know, they are carrying a loss, there may be many reasons, so it means that they are not really liquid, no? So there is a liquidity risk in having this reliance on the repo market. Well, what that means also, that what they try to do is also that they try to lend out money with the reverse repo. So they try to do something, but the repo rate is 4.36. So they try to have the reverse repo, it's slightly lower. Let's say it's 4.1 or 4.2. Okay, so anyway, in the spread carry trade, they still lose money. Okay, they have to pay more for their 18 billion. Not only the notional amount, it's minus 5 billion. Minus 5 billion. So they need 5 billion more in repo to what they can lend out in reverse repo. But the spread between the repo and the reverse repo is not in their favor, at least what is my knowledge. I may be wrong, but then because probably, I don't know, Jefferies can have its own arrangements with its own clients, and then they can charge more for the reverse repo. But I don't really know what is the thing. Yeah. Here we see that basically the netting amount is 5.9 billion short. It's a negative number. It's minus 5.9 or 6 billion that they are short in their netting position between gathering liquidity with the repo and doing reverse repo, and also basically borrowing stocks for hedge funds to sell short the stock or do other sorts of financial stock market activity. Okay, well then everything is netted out here. So we have 600 million, which would be the net cash surplus. But anyway, this is basically among some of the reasons why there is a lot of risky business going on, and if anything happens in the repo market, or the counterparty, or basically Jefferies Financial says, okay, I need 18 billion, and somebody says the Fed or some other large bank, which happens to be, I believe, is Wells Fargo, they say, okay, we cannot roll over the repo liquidity, and then basically it's a credit risk and liquidity risk that as Jefferies on the same. Otherwise, also here, if they do reverse repo and one of their clients has a liquidity shortfall, there is a problem also for Jefferies, which doesn't see the incoming cash flow that they thought they were going to have because they are doing the reverse repo. So this is all basically a circle of money or liquidity between repo agreement and reverse repo, which is very, very risky, because in all this domino effect, if one of the parts starts to have liquidity issue in the system, then you have repercussion all along the market, the overnight funding market, and that shows up in the stock price, of course. So that's another thing. So, and that's Jefferies. Then we have Western Alliance. Western Alliance is another very interesting thing, because Western Alliance, it's in the business of mortgages. Western Alliance Bancorp. Western Alliance Bancorp is in the business of mortgages, and this Western Alliance is really, really, really burning cash like there is no tomorrow. It's probably it's really going bust. It's probably going bust for sure. So first thing first, we see that they have a constellation of things. So we have Western Alliance Bancorporation. It has a constellation of entities and divisions. It has small entities, which basically provide credit in the real estate market, so real estate or other subsidiaries, insurance, and Las Vegas, if you want properties. Oh, that must be a casino business properties, which is unbelievable. So what they do, they have this plethora of small subsidiaries which carry all sorts of dodgy stuff, and they are in the business of lending, issuing mortgages, buying those securities, and reselling mortgages, and they have basically this held for sale or held for investment credit derivatives, and they do this business. But at the end of the day, they buy these mortgages, they repackage it. It seems like the movie, but you see here mortgages servicing rights. So they do actually they do this business. And then here, investment in stocks, equities, 100 million, but the bulk of the business, you see, it's loans held for investment, net of deferred fees and costs, 56 billion. And then they have a mortgage business services, which seems to generate money, but it's not as good as it seems. Now, the first thing that we can see is that they have so very minimal provision for credit losses. So what they do, because all these investment banks, when they have to do the stress test, they consistently mark up their assets. While for all the billions of dollars in line of credits they give, or this repackaging of mortgage-backed securities, and they mark up the value of those credit derivatives, when in reality, if I have I don't know, 2 billion in credit exposure, what actually I'm going to recover, it's 10%. I don't know, it's 20 million. That's how it works. If I have an MBS and the asset is 5 billion, okay, let's call it 5 billion, which is a very large thing. But the real value of that, it's, I don't know, 500 million, 10%. That's the real value, okay? But I'm still carrying this stuff. I'm marking up the asset as AAA mortgage-backed securities, as is worth 5 million. Then what happens is that also they have this very ridiculous provision for credit losses, because they don't account for what is the real value of those credit derivatives. And if and when basically you have problems in the commercial real estate market, and then they still mark up their assets, which are not, eventually not all they are worth exactly what they paid for. And so basically those credit derivatives, they are, or their loans held for investment, they are worth much less than 56 billions. And then they have these ridiculous provisions for credit losses, which are, I don't know, 1% of, less than 1% of 56 billion. I mean, these are ridiculous things. And here we have some of the dynamics that explain a bit. So what they do, purchases and origination of loans held for sale. So they buy loans, which can be mortgages, and they spend 26 billion and 746 million. And then proceeds from sales and payments on loans held for securities and related securitization activities, 25 billion. So net, you're already losing 1.7 billion in all the cash flow. If I'm buying loans and repackaging, and I'm issuing loans or mortgages, and I hold these mortgages hold for investments, these are 56 billions. Then they do this operation, they securitize this whatever products they have, loans, leases, mortgages, commercial real estate, whatever it is, and then they spend 26 billion, but then the proceeds are 25 billion, they're already burning 1.7 billion. Okay, and then you see here net cash used in investing activities, they are losing 5.5555 billion. Okay, 5.5 billion. So they are burning money. And that's this one, Western Alliance Bancorp, that to me it's worth zero. Okay, Western Alliance is worth zero. Okay, zero. Can I have my brush? Zero. It's worth zero. Minus 10, zero. Okay, because they are burning cash. They are buying mortgages, they are repackaging it. They are creating these credit derivatives, they are doing all the layering and the securitization and all the thing that proceeds is 25. And their net cash requirement is minus 5.5 billion. So they are burning cash. So basically Western Alliance stock is worth zero. Okay, not only because they are burning cash, but because they are dealing with mortgages, they are dealing with loans, with credit products, and they are doing all this securitization business, which is highly risky, but it's toxic. Basically, they are toxifying the stock market, and this will have very big repercussions. It means that we have not learned anything since 0709. They're doing it all over again on a much larger scale. So mortgage services rights capitalized. Okay, here they are losing $500 million on mortgage servicing rights. So they are even losing money with that. Net cash. So net cash from operating activities, they are losing minus 2 billion. And the year before they had lost 1 billion. And the year before the loss was bigger at the end of the fanfare, it was 6 billion. Now they are down 5.5 billion. So they are burning cash. And it's truly a disaster. This is a toxic stuff. This will have to be wound down. You'll have to wind down this thing, this Western Alliance Bancorp, and all these subsidiaries. The problem is that they have, it's like a giant octopus with all these many subsidiaries and many tentacles, issuing all these loans held for investment. And then they try to do the business of securitizing mortgages, and then they lose money. We see here they lose money. 6 billion the year 2024, now 5.5 billion. Net increase in loans held for investments. They are also decreasing the loans that they hold for investment, because probably they want to get rid of this stuff, because it's worth zero. Yeah. Western Alliance Bancorp is worth zero. Short the stock all the way down to zero. Okay, because that's really rubbish. And then they have increasing deposits. If you have money, is it insurance guarantees? Oh, good Lord! If you have a checking account with Western Alliance Bancorp, go and take your money out now. Yes, you won't find your money. Are they guaranteed? Okay, yeah, okay, yes. It's FDIC guaranteed. That's $250,000. But I mean, a cash financial activity. This is ridiculous. This is really ridiculous. Deferred income tax. They are even managing not to pay taxes. Because they probably are really so short of money. They are burning cash like it's incredible. It's really incredible. Let's see if what we can find out. Okay, so here, held to maturity, what they have in the belly, residential mortgage-backed securities. And these are probably government agencies, that securities. Treasuries, then CLOs, and then it's private label MBS. So they have available for sale 17.5 billion. And it's more than what they had the year before, because the year before then, at December 2024, they had 14 billion. So they are even taking more risk, which is unbelievable. What they got a bit more of treasuries, so they are trying to shore up the thing. They've issued a bit more of collateralized mortgage-backed securities, which are probably GSE, Ginnie Mae, so these are the federal agencies, okay, which basically it's made to make it appear something like it's decent stuff, but these are mortgage-backed securities. Mortgage-backed securities, so are credit derivatives. It doesn't matter if are government, federal agencies, these are very risky stuff. So, yeah, okay. And we see here, held to maturity, these are all AA, AAA. Okay. Yeah, these are all AAA mortgage-backed securities. That's the trick. Okay, I have, because these are all covered by the federal agencies for the housing market. Okay, so this is 07, 09 all over again. It was also first brand corporate debt was all AAA corporate debt, and now we know it was not. Okay, held to maturity. Okay. During 1 year or less, 24 million. After 10 years. Okay, during 1 year or less. So available for sale. So they have 1.6 billion of these credit derivatives, which are due in 1 year or less. And if something goes haywire, because they start to have credit losses, we have 1.6 billion of AAA mortgage-backed securities, which will have to be dumped in the market. After 1 year through 5 years, another 1.9 billion. And then, okay, for these mortgage-backed securities, we don't have the duration, because the total is 8.7 billion here. So they have MBS for 8.7 billion. You may say I'm a dreamer and say, okay, 8.7 billion, it's nuts. No, it's not nuts. It's not nuts, because there is, remember, there is all, it's an octopus with also all the tentacles. There are all the subsidiaries, and God knows what else comes up. And yeah, that's a bit of a flavor what comes next. Net proceeds from sales of loans. Okay, so they are losing money. That means that they buy those mortgages, as we saw before, they securitize it, then they resell it, and the proceeds from the loans, they lose money on what they paid for. So so what can I say? What can I say? Western Alliance Bancorp stock is worth 0. Sell this thing now. It's unbelievable. It's really unbelievable, this thing. Allowance for credit losses, 395 million. Okay. But if you just wasted 62 million, so how can that make sense? And basically, you're burning cash. You're burning $5 billion of cash. And yeah, I mean, here, net operating cash net cash from operating activities, it's net cash flow, it's a loss of 2 billion. And you're burning 6 or 5 billion. And then you say, okay, no, but don't worry, my credit provision loss is $200 million. It's, I mean, that for sure, allowance for credit losses, 395 million on the whole thing, loan, leases, and whatever they are holding, CRE, non-owner occupied. Okay, so they have commercial real estate, 6.5 billion. All this stuff, yeah. They have 50. That's their investment portfolio, 55.5 billion, and they basically account only for 395 million allowance for credit losses. When they do their business securitization of all these things, or all these credit products, and they are losing 5 or 6 billion per year. So how can it be that your allowance of credit loss is 395 million? That's ridiculous. Why? Because they mark up the value of this thing. They mark up the value of the commercial real estate. They mark up the value of the asset. If this stuff, then it has to be priced effectively for what it's worth. Just find me tomorrow somebody who's gonna buy a casino in Las Vegas. Okay, so I have a $20 million house in Arizona or in California. I want to find a buyer, and somebody comes up and say, okay, no, I'm gonna give you 18 million or 15 million. Then the value of that asset, you cannot mark it up. The real value of the asset is not anymore 20 million, it's 15 million, 10 million. And so the value of this stuff, it goes down. What they have on the book is not what actually it's really worth. And this credit loss is nowhere near, because actually it's already in their books, is nowhere near, because they are burning 5 or 6 billion a year in the securitization business. So how on earth the people who read this stuff, they say, oh no, everything is fine? I mean, I'm not an expert, but I don't know how the regulators, they say, okay, no problem, carry on, it's fine, crack on, mate, no worries. It's unbelievable. I think warehouse, okay, So they're just giving out 8.5 billion in warehouse businesses. Okay. Other commercial industrial 10.4 billion. But here it's very, very interesting. These are small details, but they are very funny. CRE owner occupied. So it means that, I don't know, there is an industrial site, and the owner of the manufacturing factory, it asks for liquidity. Okay, so they extend a line of credit in which can be basically classified as commercial real estate loan. But then there is the business of no longer occupied. So there are these magic entrepreneurs which go and ask for money to basically acquire sites of industrial sites which are not occupied. There is no productive activity in it. And then they advertise, they say, okay, I have these sites for this manufacturing, or I have these warehouse spaces. And then they don't fill the space, they don't have the cash flow. And then, do you get me? There is this magic entrepreneur, this magic Richie Rich, okay? He goes to Western Alliance and says, okay, wait, you see here, I have this huge, wonderful warehouse. Just give me some. Give me 100 million. Yeah, 100 million. Chuck in 100 million. I want to buy this warehouse, and I'm gonna rent it to somebody, to some startup who does drop shipping, right? And then they give out this credit, and they have 6.5 billion in CRE, other CRE, which is non-owner occupied. So it means that there is this magic Richie Rich, which is the intermediary between the bank and the warehouses, or the, I don't know, startups, or the manufacturing, any industrial site or manufacturing site, or actually warehouses or commercial real estate. It can be shopping malls, anything. So there are 6.5 billion which are exposed of credit, which are exposed to an intermediary who does the business, which are non-owner occupied. It may be that it's not, there are intermediaries who say, okay, I use that facility, I want to acquire the rights of using that facility, that shopping mall, I want to manage the shopping mall, and I need money. So there is an intermediary who takes that liquidity, and then it tries to do the business of renting out the spaces in the shopping mall. It's a bit of the same as the WeWork business. They rent working desk. Oh, Jesus Christ. It's unbelievable, That's the business of Richie Rich. Yeah. Mate, check 100 million for me. I have a warehouse. I'm gonna rent the warehouse to drop shipping. I'm gonna rent out the shopping mall, and then I end up with fucking sorry for my French. And then it's rubbish, basically. It's total rubbish. And the non-owner occupied commercial real estate credit is 6.5 billion. And the owner occupied is 1.5 billion. Of course, because they're gonna charge more for that line of credit, but it's way riskier. And we know that with online shopping, you may need warehouses, but how many? And then you are not the only bank in the whole United States. I mean, so it's all clear to see. Thanks to Richie Rich, the intermediary of the real estate, commercial real estate. And then the bank goes bust, basically. It's all failed entrepreneurs. It's just It's, unbelievable. Warehouse credit, 10.5 billion. It's not small stuff. Other commercial and industrial, 10.4 billion. Residential, 13 billion. Okay. Wonderful. We need to read the small print. The following table presents an aging analysis of past due loans by loan portfolio segment. Okay. So past due is this. Okay. 30 days. Okay. So we total. The total. Okay. So if we add up what are the past due, so they are booking up the balance sheet something that is past due 30 days, 60 days, 90 days, then it's gone basically. It's not gonna pay you back. That's the thing. And total past due 720 million, which it can be more than that. If there is more deterioration, but we don't know exactly the numbers. We know what it's here, but still they have a book of 54.7 billion, 54 billion and almost 800 million. So for sure, the credit loss is gonna mount up. We could make a ratio like 4 million of 3 billion. Okay, I'm too busy to do the ratio. I'm too lazy, but I got other stuff to do, such as studying for university. And so my suggestion, short Western Alliance Bancorp is zero. The value of this stock is zero. And with that, I have to love you and leave you. And it's been a pleasure. And we'll see what happens in the stock market. Have a good day. Enjoy.